If you think that investing costs about 1% a year in fees, this video is going to shock you. That 1% is just the tip. The rest of the fees and costs, they're hidden under the surface. These are costs such as trading spreads, ETF and mutual fund internal fees and cash sweeps. And then if you have a 401k, you have all sorts of administrative costs that are, again, hidden from view. In the next 10 minutes, I'm going to show you the iceberg, the fees and costs that are below the waterline that you don't see. So there's this 1% myth. And that is that we're just paying 1% in fees like advisor fees and so forth. But really, there's an iceberg hiding much more. Most families, they see a 1% advisor fee. But if we zoom out and take a look at the financial industry as a whole and look at how much revenue they're actually pulling in, the system-wide take is much larger than that 1%. I thought it would be helpful to draw a picture. And this picture is going to be of the iceberg. And with this analogy of iceberg, a majority of the iceberg is under the waterline. The part we can see is that 1% fee. But everything else is hidden or hard to find below the waterline. What does this include? Well, first, we have trading spreads. We have fund costs that are internal. And this includes things like trading, cash drag, and soft dollar. Then you have program or platform fees. Then if you are in a 401k, or part of your portfolio is 401k, in a 401k, you have all of these fees plus admin costs, bookkeeping costs, and so forth. And finally, cash sweeps. So this is a quick list of the below the surface cost and fees that may be affecting your investments. This doesn't apply to all investing. Some of them don't apply, right? It depends on your situation. But this is a good overview of the below the surface list of fees and costs. In fact, there'll be, in some situations, maybe more than this. It depends on the situation. Looking at the big picture numbers as it relates to the financial industry and the fees and costs that they actually collect, we can see that American families have tens of trillions of dollars in assets at financial institutions. Then, if we look at the income or the revenue that the financial institutions are actually collecting, it's in the trillions of dollars. And if we analyze the numbers further, what we see is that the financial institutions are collecting about 10%. That gap between the 1% and the 10%, those are the costs and fees that are hidden below the waterline that make up a majority of that iceberg. The funny thing is commissions went to zero, but the industry didn't get any poorer. So all of that revenue, all of that money that used to be paid in commissions, it didn't disappear. It just migrated below the waterline where people can't see it. Really, the situation is zero cost on the front end, but plenty of cost on the back end. So the conclusion really is that revenue migrated. It didn't vanish. Where do these fees hide? Let's go a little bit deeper on the subject without getting too far in the weeds. First is the bid, ask, and block trading. Really, the simplest way to explain this is using the analogy of wholesale versus retail pricing. If a financial institution is buying stock in big blocks, they're getting wholesale pricing. And then they're turning around and providing it to individuals such as yourself at retail pricing. The difference in price, well, that's profit, right? Now, number two is fund internals. When I say internals, I mean internal costs beyond expense ratio. That includes trading. It costs money to trade stocks or bonds. You also have cash drag. Any cash sitting in a mutual fund or ETF is not working for you, right? It's not invested because it's cash. And then soft dollar. This is when a company that sells computer hardware goes into a mutual fund and says, hey, we'll give you all of your computers and all of your technology. We'll set it up. Don't pay us anything right now. It's going to be a fee that's going to come out of the fund's money. And we have platform or program stacks. This is how many middlemen are between you, your advisor, and the ultimate investment. So you could have yourself, the advisor, then you have the wholesaler of the mutual fund, then you have the mutual fund itself. So these are different platforms that can be stacked on top of each other, increasing little bits of fee all along the way. And then finally we have cash sweeps. Every mutual fund, ETF, they all have a certain amount of cash that is sitting in the fund. There's interest paid on that, but not as high as it could be. So you as the individual might receive 1% interest on the cash sitting there, whereas the financial institution is receiving 4%. That 3% gap, well, that is profit to the financial institution. I put together a checklist for you so that you can really have a better understanding of the fees and the costs that you are paying. So first at the top is advisor fee. Of course, if you are a do-it-yourself investor, this does not apply. Then we have the program or platform fee. Then we have the fund fees. And this is things like expense ratio, which is disclosed. But then the other hidden fees, which is we've talked about trading, soft dollar, and cash drag. And then if you have a 401k, you have admin fees, bookkeeping, plus these fund fees as well. Then when it comes to cash, as it relates to one of these funds, the interest rate that you receive versus the interest rate that the financial institution receives. So this is really a majority of the costs and fees that may be hidden when you invest. Each line item does not apply to everyone in every situation, but these are the fees to look for and be aware of. It's important to point out that 1% advisor fee may very well be worth it. If your advisor is helping you plan your retirement, make solid financial decisions, helping you with things like tax planning and estate planning on top of investment decisions, that 1% fee might very well be a bargain. The red flag isn't the 1% that you see, it's in the 2 to 9% that you don't see. Look for transparency in fees and costs. Avoid theatrics. Bottom line, zero commissions didn't remove revenue from financial institutions. It just relocated it to where you couldn't see it anymore. The antidote to all of this is fee stack transparency. So you know exactly where your money is going and what you're paying for. In some cases, the cost is worth it, and that's fine. In other cases, through this new understanding, you'll be able to look at your entire fee structure and maybe find ways to reduce the fees and put more money in your pocket. If you want a plain English fee stack review of your current situation, there's a link down below the video where you can get your fee clarity call. It's a 15-minute call. We'll simply map your stack of fees. We won't give you investment advice. We'll just show you the fees. Then, if you feel like it's a fit, we'll talk about next steps. Otherwise, you can just keep that checklist. Now, I have my disclaimer. This is not investment advice. This is not tax advice, nor legal advice. It's really important that before making any investment decisions, talk to a licensed professional such as myself. Any numbers that I used during this video were directional and used to show concepts. Last words, know the iceberg, keep your money.